Section 1035, the exchange may be with the same insurance company or with a different insurance company. However, if the exchange involves life insurance, the life insurance policies must be on the same insured, and if the exchange involves annuities, the annuity contract must be payable to the same person. Remember, under Section 1035, the IRS will never allow you to better your tax position. Corporate retirement plans. We will talk in general about how retirement plans work, the basic rules as far as how they go, and then we'll go one at a time into the different types of retirement plans. I will not discuss within this section any of the current year's contribution limits. There is a video that pertains to the current year that discusses your current year's contribution limits. So although you will want to know those for the test, I won't discuss them in this portion of the video. We'll just talk about them on a general basis. So the idea that where you work, you may have a retirement plan. These retirement plans, generally speaking, are what we call qualified plans. A qualified plan is going to have to do certain things. Qualified plan. There will be certain things that are true about all of the qualified plans that we talk about. One of them is that it's funded with before tax dollars. So the money that goes in has not yet been taxed, pre-tax dollars. The idea being upon withdrawal, they will be taxable, your withdrawal will be taxable at ordinary income rates. So the money that goes into any of these qualified plans, pre-tax dollars, generally speaking, both the employer and the employee are able to contribute. So that when the employer contributes, it allows them to have higher expenses, which reduces their taxable income. So it is a tax write-off for the employer. It's why they do such nice things for us, right? To reduce their taxable income. When you have a qualified plan, certain Internal Revenue Code rules must be followed. If these rules are followed, the money goes in pre-tax dollars and the earnings are tax deferred. So no taxes are owed until the money is taken out. Cost basis is 0. So qualified plans are going to follow this set of standard rules that we're going to elaborate on. A non-qualified plan does not have to follow these rules. Non-qualified plans do not. So they are not going to follow what's called ERISA. They're discriminatory. A non-qualified plan is usually set up in favor of higher paid workers. So non-qualified plans may be discriminatory, where qualified plans may not be discriminatory. So your 401k is a qualified plan. The most common example of a non-qualified plan for the purposes of your exam is deferred compensation. So let's say your business has 100 employees, but you have a couple of people that you really don't want to lose. So you say, hey, look, for just you guys, we're going to set it up so that if you work for us for the next 20 years, when you retire, we'll keep you on the payroll. So it's a deferred compensation plan. And, that sounds great. If the business goes broke, however, there is no pre-funding of this deferred compensation plan. If the employer goes broke, those persons who thought they were going to get paid when they retired won't get anything at all. So if the business should file for bankruptcy or insolvency, the persons that were promised the deferred compensation plans will actually get nothing. So non-qualified plans, they don't follow ERISA, they are discriminatory, they are unfunded, and an insolvency of the company will result in no payment being made to the persons to whom deferred compensation was offered. So we're not really concerned with non-qualified plans, short of knowing that deferred compensation is one of them. Many more questions on this concept of these qualified plans. So if we've got pre-tax dollars going in, pre-tax dollars go in, your cost basis in a qualified plan is 0. So none of the money has yet been taxed. 100% taxable as ordinary income upon withdrawal. So we know that so far. Tax-deferred earnings. Under ERISA, now ERISA stands for Employee Retirement Income Security Act. ERISA was originally passed in 1974. Before ERISA, you could work somewhere your whole life, and right before you were going to retire, they'd fire you, and then you'd lose whatever your employer had set aside in your qualified plan, which was just unfair. So ERISA sets forth certain guidelines that all qualified plans must follow. ERISA says that there are 2 types of pension plans: defined benefit plans and defined contribution plans. So this idea that both defined benefit and defined contribution plans are qualified plans. Defined benefit and defined contribution. They are both qualified plans. How they're set up is slightly different. So defined benefit plan promises a specific monthly benefit at retirement, so that how it's funded, it depends upon the formula that's used as far as what is the person's promise. What is their promise is probably a bad word to use. Employees feel like they've been promised, but what happens sometimes is the employer, if an employer goes broke that has a defined benefit plan, the assets in the defined benefit plan will become the property of what is called the PBGC, which is the Pension Benefit Guaranty Corporation. And then what people were told that they were going to get very oftentimes is not what they end up getting, because the assets in the fund are not enough to cover the promise. So for example, United Airlines had promised pilots under a defined benefit plan $100,000 when they retired. And then when the United went broke, the assets went into the PBGC. And I think the airline pilots were getting about $30,000 a year in retirement, so significantly less than they had planned on receiving. Defined benefit plans are the only plans that are covered by the PBGC, the Pension Benefit Guaranty Corporation. So the defined benefit plan has a formula that considers such factors as salary level and years of service to determine how much the person's benefit will be. You don't see as many of those today as we have had historically in the past. It's much more common today that the qualified plan, instead of being defined benefit, is set up as a defined contribution plan. So in a defined contribution plan, the employer puts in 2% of your salary, or 1%, or 3%, or 0.5%. Whatever it is, it's a contribution amount that they make that is what they have defined. And it does have to be non-discriminatory. It can't be 10% for certain workers and 1% for other workers. It has to be the same for everyone. So defined contribution plan does not promise a specific amount of money at retirement. Instead, they promise to contribute a specific percentage of your salary into that defined contribution plan. ERISA sets forth the eligibility guidelines for most qualified plans. There's going to be a few that have slightly different rules, but generally speaking, qualified plans eligibility requirements. Now, the business can always set it up so that it is better than this. It just can't be worse than this. So 21 years of age, 1 year of service, and full-time. Once again, that's not to say that they couldn't include in their qualified plan someone who just started today, who is only 18, who only works part-time. It really depends upon the employer. This is just the worst that ERISA can set up as far as eligibility guidelines. So if these things are true and where you work has a qualified plan, it must include you. So if these are the rules for your company where you work and you've only been there for 6 months, you're not enrolled in the qualified plan yet. But after the first year, you have the right to enroll. Vesting. Vesting means ownership. So most of these qualified plans that we'll learn about, both the employer and the employee contribute into most of them. So when you're the employee, and let's say you put in 5% of your salary into the qualified plan, when do your contributions belong to you? Right away, immediately. It's your money after all. So your contributions belong to you right away. When do your employer contributions belong to you? So ERISA sets forth vesting schedules. With slight exception that I will point out, the vesting schedule must be set up one of these two ways. So when is the employee going to own the employer's contributions? So there's two vesting schedules. So this is the employee ownership of employer contributions. So they can set it up one of two ways. There's what's called a cliff vesting schedule and a graded vesting schedule. Under the cliff vesting schedule, after 3 years in the plan, the employee is 100% vested. After 3 years, the employee is 100% vested in employer contributions. So one of my girlfriends, she was working at a large business, and she said, do you know what? I have 6 more months till I'm vested. She said, I hate my job so much, I quit. So it is done for employee retention so that employees think about before they leave this idea of, does that money belong to them yet? And she said, there is no amount of money that would make me stay at my awful job. I felt so bad for her. But I thought that it was interesting that it was something that she thought about. So employers do like these. It's expensive to train employees. So done to encourage employee retention. So her place of business had a cliff vesting schedule. A graded vesting schedule works like this. Starting at the end of your 2nd year, you must be a minimum of 20% vested. 3rd year, 40%. 4th year, 60%. 5th year, 80%. So that by the end of the 6th year, you are 100% vested. So once again, these are the worst that they can be set up to be. It might be a graded schedule where the employee is 100% vested after the 4th year. That would be fine. The company can always make it better than one of these. But this is what the Internal Revenue Code says, ERISA says, if the employer chooses to have one of these vesting schedules, the worst it can be. Distributions from qualified plans can be made in many different ways. Commonly, someone reaches retirement. So distributions made in the event of retirement usually take one of two forms, a lump sum or a series of monthly periodic payments. If any form of an annuity is provided, the plan must make available a qualified joint and survivor annuity. So that's the choice that pays until the last spouse dies. The IRS mandates that unisex annuity tables be used when purchasing annuities for new retirees. The lump sum distribution is one in which a participant's entire retirement account balance is distributed in one taxable year. Remember, the cost basis in a qualified plan is 0. Taxable is ordinary income when it's taken out. Another way you can get a distribution from a qualified plan is due to disability. So this idea that the IRS says anytime we're going to defer taxes on something, this qualified plan, if you take your money out under age 59 and a half out of a qualified plan, not only is it taxable as ordinary income, but it also has a 10% early withdrawal penalty. Although we will waive the penalty for disability. So they will waive the 10% penalty if the money is being taken out for disability. They'll also waive the penalty upon death of a plan participant. Cost basis is still zero, however, taxable as ordinary income. Upon death of a plan participant, if payments are made in a monthly or periodic installments, the recipient beneficiary pays income taxes on them just as the retiree would. Upon termination of employment, very oftentimes people will take a distribution from their qualified plan. The best thing to do if you don't want to have a taxable event is to roll over the distribution into a conduit IRA, and then from the conduit IRA to the plan that your new employer has. So if you do that, if you follow the Internal Revenue Code, which says rollovers must be made within 60 days of a distribution to defer taxes. So if you do that, if you follow that rule, it won't be a taxable event. If you have that money in your hand for longer than 60 days, you will end up owing income taxes, ordinary income taxes, plus a penalty if you're under 59.5. So you really want to make sure if the money does come to you that the rollover is made within 60 days. The best way to do it is directly from the trustee of one qualified plan to another. When you switch jobs, just directly roll it over, then there's no 60-day rule. There would be no taxability at all. We talked about premature distributions. Those are those that are made under age 59.5 out of a qualified plan. Will have a 10% early withdrawal penalty unless it's disability or the employee has died. There's other certain exceptions later on that we will talk about as well. Types of qualified plans. So the 401k is for large businesses. Everything that we talked about already is still true. Funded with pre-tax dollars, earnings are tax deferred, 100% taxable as ordinary income. We'll talk about the limits for them in this year later on. Both the employee and the employer may contribute to a 401k. Generally, withdrawals from a 401k that are made under 59.5 will have that 10% penalty unless it's due to death or disability. So 401ks, qualified plans for large businesses. There's a lot of very specific rules that the employer must follow in establishing the 401k. But overall, everything that we talked about, non-discriminatory, all of those ERISA rules, the vesting schedule, that's true for all of these plans. So large business, 401k. The Simplified Employee Pension Plan, the SEP IRA, is a qualified plan for the small business that has no more than 50 employees. So SEP IRA. So we've got 401k large business, 401k large business. SEP IRA, small business. All the same rules. Pre-tax dollars, non-discriminatory, 10% penalty under 59.5, zero cost basis. Small business, up to 50 employees. Up to 50. The SEP IRA has an interesting eligibility requirement. So it's slightly different than what I previously talked about. So this is specific to the SEP IRA. So the strictest the eligibility requirement may be for SEP IRA is age 21 or older, so that's the same, has worked for the employer for 3 of the past 5 years, that's new, and has received at least $550 in compensation from the employer that year. So that's nothing, $550. Work for the employer 3 out of the past 5 years, 21 years of age or older. Those are the strictest the eligibility requirements may be for a SEP. SEP IRAs are funded by employer contributions only. Contributions do not have to be made by the employer to the SEP IRA every year, but in years that a contribution is made, they must be made to the SEP IRA of all eligible employees. Some SEP IRAs will allow non-SEP contributions to be made. So we talk about overall the employer funds a SEP IRA. Depending upon how it's set up, sometimes the employee can contribute. What can the employee contribute up to that current year's IRA limitation? So the employee, if they can contribute, it would be it's called a non-SEP contribution. They can contribute whatever the normal IRA contribution limit is that year, including catch-up contributions if applicable. Catch-up contributions do not ever apply to the employer contributions. So small business. Simple. Simple plans. Simple stands for Savings Incentive Match Plan for employees. Simple plans. Also for small businesses, but they can have up to 100 employees. So they're simpler to administer than 401ks. That helps me remember. Small business. The simple has some things that are really unique to it. The strictest eligibility requirements for a simple may be that the employee must have received at least $5,000 in compensation in the previous year. So $5,000 in compensation. So if in the previous year, so this could include obviously part-time people, compensation of $5,000 or more, then they're eligible to be enrolled in that simple. I'm going to slightly change this. We're going to say under 100, under 100 employees. So what was the contribution requirement or the earnings requirement on the SEP IRA? Compensation requirement was $550. 3 of the 5 years was a rule as well. So these do have some unique eligibility guidelines. So simple IRAs. Employees may contribute to a simple IRA up to the current year's contribution limit. Employers contribute as well. So when we had the SEP, we said employers for sure, and then we said some SEP IRAs allow for non-SEP contributions to be made by the employee up to the IRA limit of the year. Simple plans allow for both the employer and the employee to contribute. So we call this a salary deferral, pre-tax dollars, of course. How the employer chooses to make their contributions, there's 2 ways in a simple account that the employer can choose to make their contribution. A dollar for dollar matching contribution. So a match, the match 1 to 3%. So it has to be the same for everybody. It can't be 1% for some people and 3% for others. It has to be the same for everyone. Or a non-elective contribution amount that must be 2%. So I'll explain what this means. So non-elective. So let's say that the employer has a match. The match can be 1 to 3%. So let's say that it's 3%. If the employee contributes 1%, how much does the employer have to contribute? 1%. If the employee doesn't contribute at all, how much does the employer have to contribute? Not at all. If the employee contributes 10%, how much does the employer have to contribute? 3%. So match, they can do the match. If it's a non-elective contribution by the employer, what that means is that it doesn't matter if the employee enrolls at all. So if they're not putting in any money or they're putting in 1% or 10%, it doesn't matter. The employer puts in for everybody 2% of their salary, of that employee's salary, as a contribution. So that's the non-elective contribution. It's up to the employer which one they choose, and they can switch back and forth by notifying the Simple IRA company should they choose to do that. Something else that is interesting about a Simple IRA is that The employees vest immediately. Now, this is very unique to the simple plan. Employees vest in employer contributions right away from the beginning. That's very unique. It's the only one that we do this, immediate vesting. Because of that rule, simple plans are subject to a 25% IRS early withdrawal penalty if a distribution is taken in the first 2 years of the plan. So I don't really care what your age is. If you just got into that simple plan and you take money out during the first 2 years, cost basis is 0. Not only will you owe ordinary income taxes, but there is a 25% penalty for distributions made during the first 2 years of when the employee enrolled in the plan. That's pretty significant. Keogh plans, HR 10s. Now, there are certain things about these plans that are beyond what I cover for your course. So as far as when can you make contributions, when do you have to set it up, I do know a lot of those things, but I don't expect them to be on your test. So that there are some details that I do always leave out of the discussion. Keoghs for self-employed people who pay Social Security taxes. Keogh plan. So when you're self-employed, you have to pay Social Security on your earnings, just both sides of it, like the employee and the employer. So you're allowed to reduce your taxable income by making a qualified plan contribution to a Keogh account. So self-employed people could also choose to have a SEP IRA. So Keoghs for self-employed people. In the case of a business that's a sole proprietor, they are deemed to have dual capacity, both employee and employer. As employers, they're permitted to deduct those contributions that they make to a Keogh. If the self-employed person has employees and they contribute to their own Keogh, do they have to contribute to the Keogh of those people that are eligible? Yes. So the 21 years of age, 1 year of service, and full time, those rules would be true as well. You would, as that self-employed person with employees, have to contribute not only to your own Keogh, but to those of any persons who are your employees. Same percentage for everyone. You can't do 20% for you and 2% for them. It'd have to be the same for everyone. So only those self-employed people who have earned income can establish a Keogh. Earned income can be defined as earnings attributed to a sole proprietorship, a partnership, or an unincorporated business. Corporations are not eligible for Keogh plans. Corporate officers may not establish Keoghs. It's important to remember that, let's say you're self-employed and have a Keogh, or maybe you work at a corporation and have a 401k, maybe you're in a simple, you can still also contribute to an IRA. So long as you have earned income, you can contribute to an IRA. So it's perfectly possible to have both of these accounts, a Keogh and an IRA, or a 401k and an IRA. We'll talk more about IRAs in a moment. Something I haven't mentioned yet is when you have a qualified plan, unless you're still working at your employer, and even then sometimes this will be true, there is a rule under qualified plans that distributions must begin no later than April 1st of the year after you turn 70 and a half. So contributions must cease, distributions must begin no later than April 1st of the year following the year you turned 70 and a half. It's called your required minimum distribution. And some plans require it to be taken even if you're still working, and some plans will defer it if you're still working at the place of employment. So those nitpicky details I do not expect to be on your test. But out there in the real world, you'll want to make sure that you understand which ones allow it, must require it, and which ones allow you to defer that. A TSA, Internal Revenue Code 403B. So we had a Keogh for the self-employed, not a corporation. That was not allowed. So KEO, self-employed, and employees. Internal Revenue Code 403B describes what is called a TSA, a tax-sheltered annuity. The only annuity that we talk about that is funded with pre-tax dollars. So TSAs are funded with pre-tax dollars. Sometimes we'll say they're available for teachers and preachers, which is just something that helps us remember. They're really available for public school employees and nonprofits. Public school employees and nonprofits. Nonprofits. So the TSA, public school employees, nonprofits. Some hospitals will be set up with a nonprofit capacity. So could a nurse at a hospital that was a tax-exempt organization contribute to a 403B? The answer would be yes. So TSAs are a type of a qualified plan. They're designed for long-term savings. The money goes in pre-tax dollars. Take it out under 59.5, you'll have a 10% penalty in addition to ordinary income. All of those rules are the same as they've ever been. A lot of times the TSA is funded entirely by employee contributions. So that you're a professor at a public university and you have a TSA, it's not that the university is contributing, it's that you, the professor, are making contributions. How much can you contribute? There is a limitation, which is something that's important to note. A non-qualified annuity, we discussed those previously, those are funded with after-tax dollars. How much can you put into a non-qualified annuity? As much as you want. Is there a limitation on how much you could contribute to a TSA? Yes. So non-qualified annuities have no limit, but TSAs, there is a limit. Employers can make contributions. I'm not saying that they're prohibited, it's just oftentimes they don't, but they may. So employees that are 21 years of age, have worked there full time, work 1,000 hours or more a year, are eligible to enroll in a TSA. How can you take money out of your TSA as a lump sum? 100% taxable as ordinary income. Zero cost basis, of course, in all of these qualified plans. When you take the money out, taxable as ordinary income. If you're under 59.5, you'll have a 10% penalty, unless, so under the TSA, we have exceptions to the 10% penalty rule. Disability, we've previously talked about. Death, we will waive the 10% penalty. On a TSA, we'll also waive the penalty due to divorce. Lifetime or joint lifetime annuity, so when you annuitize, you can do so at any time without penalty. Financial hardship, so if the house is going to be foreclosed on, can they get money out without a 10% penalty? Generally speaking, yes. A plan loan or a rollover contribution. So those are exceptions to the 10% early withdrawal penalty. So those are the types of qualified plans. We will discuss contributions momentarily.